Let's welcome Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report. You can check out his website at www.gloomboomdoom.com. Marc, what a terrible start to the markets this year, absolutely horrendous. Do you think this is the beginning of something that's much, much bigger?
Well, first of all, yes, it is true that the indices are down year to date, some by 10%, some a bit more, some a bit less. But I'd like to mention the thing. First of all, if we look at all the markets in the world, emerging markets, some peaked out actually already in 2006, 2007, and then most of them peaked out in 2011. And most European markets never made a new high. And in the US, whereas the indices were still rising or were flat in 2018, the average stock was already down substantially. The strength in the indices came from just a few stocks, the FANG stocks, and maybe another 20 shares. But obviously now the market is adjusting to reality.
But do you think we're going to see bigger lows before we see highs again, in the US market specifically?
Yes. My concern is that we may go much lower. In other words, my view has been that from the May 2015 peak, S&P 2,134, which dropped 20 to 40%. So for most stocks, we're already down from the highs by more than 20%. I think the indices will go lower. As to when we will make new highs, that I don't know, because I think we are in a situation where, because of the continuous interventions with fiscal and especially monetary policies, growth will be very, very difficult to achieve in future. And that in this environment, the valuations are quite high if there is no growth, and if corporate revenues are down, and if earnings start to go down. And where will growth come from? In 2007, the emerging world was still growing rapidly, and the debt level in emerging economies and in China were manageable. Now they're relatively high as well. So we have an even bigger credit bubble than what the central banks created in 2007.
Scary but true, absolutely. Our viewers always hear me talking about how I believe strongly that we've got to get below the high levels in the market from 2000 and 2007. In other words, the low 1500s on the S&P. But we could get as low as what we did back in 2009, which is, under 700 on the S&P here in this country. What are your thoughts about how?
666.
I'm sorry?
It was 666.
That's right, 666. What are your thoughts about how low it could go on this downward slide?
Well, I don't know. That's the simple answer. But it could get ugly in the sense that inflated asset markets, when they start to go down, they are markets. And as you see, after 2009, the global economy was driven by asset inflation and the so-called trickle-down effect that helped the economy. If assets markets go down, the economy may weaken actually more than is expected, and certainly more than is expected by the incompetent central bankers around the world, with very few exceptions.
It's funny you've touched upon the whole theme of our show today. I know you didn't have the ability to watch the beginning of the show per se, but we're talking about how normally the stock market is a trailing indicator. The economy starts to slide into recession and the stock market starts to react. And we said this is one of the first times we can actually see the tail wag the dog, where the stock market drop reverses what I call the wealth effect and actually causes the economy to sputter. And that's exactly what I hear you saying right now.
Yes, I agree partially with that, because the stock market is a better forecaster than all the clowns in the investment banks that tell you that everything is fine and that clients should buy equities and bonds and God knows what. I think the stock market is a discounting mechanism. And when you saw in 2015 many shares starting to weaken, and especially economic sensitive shares, you had to ask yourself, are all these rosy predictions by the analysts and strategists and economists at the investment banks, and especially also the rosy predictions of the Federal Reserve?
Yeah.
The Federal Reserve in the last 20 years got pretty much everything wrong they could get wrong.
Yeah, agreed, agreed. Marc, we have to take a quick commercial break, so stay with us. We'll be right back with more from Marc Faber in just a minute. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We're here today with Marc Faber, publisher of the Gloom, Boom, and Doom Report. You can check out his website, www.gloomboomdoom.com. Marc, I agree with you that had it not been for the TARP program, that the S&P 500 could have dropped much lower than 666, possibly as low as the 500 that you had mentioned. But I talk all the time about my best guess is that without all the subsequent tranches of quantitative easing, that the S&P 500 might have only gotten back up to 1,500, certainly not to the 2134 that it attained last May. What's your best guess as to how high the market would have capped out at in recent years without all that unprecedented quantitative easing?
Well, I think that the market would not have made a new high above the 2007 highs. But I equally feel that we would have less problems today than what quantitative easing programs, not just in the US, but in Japan and in Europe, have produced. Let me explain this the following way. Through the quantitative easing and artificially low interest rates, capital spending in emerging markets, notably China, continued to expand in the wake of a weak global economy. In other words, the central bank's desire, and you have to question whether that is an objective that should be followed, but the objective of the central banks was to essentially create inflation. Inflation is basically bad for everybody, but anyway, that's what the central banks wanted to do. And by wanting to do that inadvertently and unintentionally, they created even more capacity expansion around the world, which subsequently led to the collapse in commodity prices, the Baltic Dry Index, zinc, iron ore, oil, everything. And so in a way, the monetary policies may actually have reinforced the deflationary pressures we had before. And by keeping poorer companies alive because of zero interest rates, instead of the recession usually does one thing well, it reduces capacities and it liquidates badly managed companies. But because of the Fed and the other central banks' action, all the bad companies were actually kept alive, especially the banking sector. Now the banks are all tumbling in price, and rightly so, because at zero interest rates, it's for them very tough to earn any money. And the individual clients, they don't trust banks anymore because they know that the stock market is rigged by central banks, and they lost so much money after 2000 and after 2007. So basically, the financial sector is now having to contract when it should have contracted in 2008 already.
Well, I completely agree that we never would have hit record highs in the stock market after 2007 had it not been for all this quantitative easing. And you're right, deflation's a major concern out there today by many. It's been a concern of mine since 2008. How long do you think we can go through a deflationary cycle here in the United States? What do you think?
But I want to tell you something about deflation. First of all, why is it that housewives anxiously expect the months of January when department stores have sales and prices are lower? They expect and hope for these sales to come because they're looking forward to buy goods at lower prices. And I can tell you the housing market in the US would be much sounder, if prices were low enough for the typical household to afford a house. But many households, and especially young people that just finished their education, they're excluded from buying a property because the prices are unaffordable. It's an affordability issue. And you want to stimulate an economy, nothing works better than low prices.
Right. So deflation in some ways you're saying could actually be healthy for the economy, at least for a period of time ahead.
Well, we had throughout the 19th century in America deflation. And during that time, real incomes grew much more rapidly than in the 20th century, and the economy in real terms expanded much more rapidly. The central banks want mislead the public into believing that inflation is for them. Inflation is good, you know, for whom? The government. Because with zero interest rates and interest rates that are negative in real terms, the governments can keep on borrowing. And with the borrowed money that they can hire more people to control you and to impose regulation on you and to have new that restrict economic development. That is precisely the goal. Essentially, it moves into a centrally planned economy that is, of course, very bad, extremely bad for economic growth. And if you look at government spending as a percent of the economy, in 1913 in the US, it was still only less than 10%. We're now at over 40%. In Europe, it's even worse, at over 50%. And as the government has grown like a cancer, what has happened is that economic growth slowed down.
Marc, you're right. We really need to get a handle on this and stop treating the symptom and start treating the problem. And Marc,
Correct.
Unfortunately, we need to leave it there. As they say, time flies when you're having fun. Thank you so much for being on the show. I very much appreciate it. And stay with us. We'll be right back after a brief commercial break.